So let's walk through the basics of building a DCF. First, we will project unlevered free cash flow, which is the cash flow that is available to all shareholders, both debt and equity. When thinking about projecting free cash flow, we want to consider key drivers like growth rates, margins, CapEx spend, and changes in net working capital. Next, we need to calculate WACC, or weighted average cost of capital, which is the discount rate that we will use to discount the future cash flows back to present value. Our WACC consists of our cost of debt, assuming we are levered, and our cost of equity. Then we need to calculate a terminal value. While it is theoretically possible to project our FCF into perpetuity, or at least far enough out that the present value becomes meaningless, this is not standard practice. Most DCF models project cash flows out between 5 to 10 years. But how do we make a decision on this number? It's important to note that there is not an exact number of what the correct number of years is, but rather, we are looking for a point where the company has reached a steady state of projections, meaning revenue growth has slowed and steadied, margins remain constant, CapEx spend is not growing substantially, etc. Once we have reached this point, we can calculate our terminal value using either the Gordon growth methodology or an exit multiple, then discount this value back to present value. Lastly, we sum the value of the present value of cash flows and the present value of the terminal value to derive our enterprise value. Because we are using unlevered free cash flow for our formula, a DCF gives us enterprise value, the value to all shareholders.